Alphabet spent so much money building AI last quarter that it went cash flow negative. For the first time since its 2004 IPO, the stock dropped 7.1% in a day, its worst since last summer. Same week, a Chinese lab gave away a 3 trillion parameter model for free. Those two things are the same story. And if you only take one thing out of this week, take that one. This is your system update. Act 1. The bill came due. For 3 years, the trade was simple. Announce enormous AI spending. Watch the stock go up. Investors treated it like proof you were serious. That flipped this week. Big Tech's combined capital spending for this year now sits around $725 billion, up about 77% from $410 billion last year. And there's something near $950 billion penciled in for next year. Microsoft, around $190 billion. Amazon, around $200. Alphabet, up to $205. Meta, $115 to $135. And the market finally looked at that and blinked. Alphabet, worst day in over a year. Tesla, down 14.5%, its worst since March 2025. Chip stocks shed more than $1 trillion across the sell-off. Now watch this. Meta grew revenue 28%, faster than Microsoft grew. Profit fell 14% on infrastructure, and the stock got hit 10%. Microsoft grew slower, 18%, but its Azure AI business is running at a $37 billion annual rate, up 123%. One line from the week explains the whole shift. Quote, "People are really focused on CapEx, obsessed with it. It used to be the more the better, but now it is the less the better." Act 2. And then they gave it away. Line up what shipped in the exact same 7 days. Kimi K3 landed July 27th, the first open model in the 3 trillion parameter class. Then Inkling, out of Mira Murati's thinking machines. And the MCP spec, the plumbing standard that lets agents talk to tools, got its biggest update since launch on July 28th. 2.8 trillion parameters. A 1 million token context window. $0. None of it cost you anything. Here's the read. And it's why this week matters more than the numbers suggest. The giants are absorbing the cost and the risk of building the thing you get to use for free. Alphabet went cash flow negative for the first time in 22 years, buying GPUs, land, power, and cooling. Investors are furious about it, and the capability that spending produces keeps leaking downhill and landing on your desk. That's always been roughly true of infrastructure buildouts. Railroads bankrupted their builders and left the tracks. Fiber operators went under in 2001 and left the internet its backbone. The people who got rich off both mostly weren't the people who laid them. What's different is the speed. Fiber took a decade to go from overbuilt to useful. The gap between Alphabet's CapEx and your free 3 trillion parameter model was about 4 days. So when you see headlines about an AI bubble popping, understand what's actually being said. Not that the technology stops working, that the people financing it might stop getting paid for it. Those are extremely different events. Act 3. The boring stuff shipped and the exciting stuff slipped. This is the pattern of the week, and honestly, it's the pattern of most weeks. Figure built its 1,000th robot on July 23rd. Its factory is running at 1 robot per hour. No keynote, no reveal event. Just a production line, quietly turning out humanoids at a rate that would have sounded insane 18 months ago. Meanwhile, Tesla's Optimus got its Fremont line converted, and production hadn't actually started as of mid-July. Musk set expectations himself. Initial output will be extremely slow, because roughly 10,000 entirely new components have no mature supply chain behind them. Real volume waits on a Texas factory in 2027. And Unitree cleared its IPO registration in 104 days, at a valuation north of $14.7 billion, targeting 20,000 units this year. Then the glasses, which is the one that matters most long-term. Meta's Ray-Bans have passed 7 million pairs sold. And this week, a BBC investigation documented dozens of men using them to secretly film women. Apple's answer slipped about 6 months to June 2027. On-device processing, a hard ban on facial recognition, tamper-proof recording indicators. That's the actual fight in wearables now. Not resolution. Whether the thing on your face is trusted by the people standing in front of you. And the rules turned on. The EU AI Act became generally applicable on August 2nd. Today. It applies based on where your users are, not where you are. Act 4. Money held. The Fed held rates on a 9-3 vote. and all 3 dissents wanted a hike. Chairman Warsh described the meeting like this: I asked for a good family fight, and I got one. 3.5 to 375%. 9 to 3. 3 of them wanted it higher, which is not a direction anybody was pricing 6 months ago. And Bitcoin closed July up about 7.5% anyway. Sit with that. It absorbed a hawkish Fed, a $1 trillion chip sell-off, new tariffs, and crude above $100, and still finished the month green around 64,000. Solana is the stranger story. It's down 74% from its January 2025 peak. By price, ugly. Then look at flows instead of price. Spot Solana ETFs took positive net inflows on every single trading day in July, while Bitcoin funds bled billions. Morgan Stanley got approval for a spot fund at a 0.14% fee. And the upgrade to actually watch is Alpenglow. If it activates cleanly, it cuts finality from 12.8 seconds to about 150 milliseconds. That's not a speed bump. That's the difference between a settlement layer and something that feels like a normal app. So, signal and noise. Signal. Open weights caught up. A free 3 trillion parameter model with a million token context is a different world than a year ago. Signal. The MCP rewrite. If agents are in your stack. Signal. Figure at 1,000 units and 1 an hour, because production rates are the only honest robot metric. Signal. Solana's flows against its price. And watch Alpenglow. And watch Apple's privacy bet. And the noise. The AI bubble is popping. What's actually wobbling is who gets paid for the build-out, not whether the tools work. Your costs went down this week. 3 things worth carrying into the week. 1. Your input costs are falling while your competitors are rising. You rent everything. No capex, no board asking about free cash flow, no infrastructure to defend. This week made small look smarter, not weaker. 2. Recheck anything you decided was too expensive, because assumptions from 6 months ago are probably wrong now. And 3. Watch production lines, not announcements. The build-out is still happening. It just stopped being free money for the people doing it, which is exactly when it starts being useful to everybody else.